Okay, everyone, let's get into our financial literacy workshop of the day. So today we're going to talk about credit cards. So if you remember from last class, we had a lesson on savings, and then we talked about what credit was and how to build your credit and make sure that you were like on the right track. Now let's talk more specifically about credit cards that you guys can start taking out and using. So what a credit card basically is, it's a type of payment that allows you to borrow money from a bank or credit card company to buy goods and services. I guess all you guys are familiar with credit cards and you see everyone using them on their day-to-day lives. Let's be a lot more specific on what credit cards you guys should be looking for and what influences your decision on which credit card to pick. So number one, if we're going to start, using credit means you're making a promise to the bank or credit card company that you'll pay back the money you borrowed. So whatever money you spend, you have to make sure you have enough money for yourself that you can pay it back at the end of the month. If you're borrowing too much money or credit, you're not going to have the means to pay it back, and that's going to lead you into trouble and debt. So credit card companies and banks keep track of how much you owe, and you have to pay back a certain amount each month to show them that, hey, I'm a very trustworthy and reliable customer, and you should be keep giving me more and more money to spend because I'm going to pay it back. But while this happens, you're getting charged interest, which is like a fee. So the longer it takes you to pay back the money, the more money you're paying them on top of the original amount you took out. So that's why it's better to pay off your money the sooner than later, just to make sure you're not spending extra money for no reason. So, why do you need a credit card? Number one, it's very convenient because you don't have to carry around cash. I think you've seen almost everyone everyone you probably talk to has a credit card, and anytime you go in a store, you probably use a credit card. Number two, it helps you build credit, which is super important when you want to take out bigger loans for either your house, cars, just any massive purchase. Using a credit card helps, show like lenders that, you're a very trustworthy person that's going to pay them back. And that way they're more incentivized to give you the money. Finally, some credit cards actually come with rewards or cashback. So, for example, the Capital One Savers card gives you 3% anytime you do groceries shopping. So let's just say I spent $100 on buying food for the month. Well, I'm going to get $3 back, which might not sound like a lot, but over time that's going to start accumulating, which is a really good deal for you. And let's also talk about the reasons why we should be a little bit wary of credit cards. Number one, because you're using other people's money, it's very easy to overspend and get into debt because if you're using cash, you know how much cash you have, you give it to them, and you physically see it leaving you. For a credit card, it's not even coming out of like your account specifically. Someone else, a third party, is paying for it, and your job is to pay them back at the end of the month, but that means you should track how much you're spending. Number two, if you don't pay that bill on time or you spend too much, your credit score is going to go down, which makes your life significantly harder, like we talked about in the last class. And number three, you're going to have to pay interest. So if I use cash and the purchase was $20, I would only be spending $20. But with the credit card at the end of the month, with all the fees and the interest, you're going to be spending a little bit more than that, just $20. Now let's talk about the different types of credit cards that you guys should be looking out for. So the easiest one is a standard credit card, and these just have a credit limit which maxes out how much you can spend. Basically, at the end of the month, you just pay back what you spent plus a little bit of interest, which isn't going to be that high. And there might even be an annual fee just to use the card, but these are very safe options for beginners, and this might be a good option for a lot of you guys too. Next, if we want to go into something a little bit more nuanced, we have rewards credit cards. And so these ones are very specialized to certain types of fields because they give you benefits for them. So whether you're using it for transportation like flights, you can get miles back. If you're using it for groceries, you get money back. And if you're using it for other reasons like vacations, you can even get discounts. So these benefits can go a lot of different ways, but they might have higher interest rates or annual fees than a standard credit card. So if you're going to use them a lot, then it's a good investment. But if you're not going to really use them that much, you're just paying unnecessary money for no reason. And again, you must be disciplined about paying off that balance each month to be a holder of that card. Next, we have secured credit cards where you have to deposit some money as a guarantee that you'll pay back what you spend. And basically, that deposit is the same as your credit limit. So, this is for people that need to prove that they're going to pay back their money each month to the credit card company. That's kind of like the down payment that you put down as kind of insurance on their part that you're going to pay them back, because the second you don't, they're going to take that money you already gave them. Again, these are for people that have credit score ratings of either fair or poor and want to improve their credit score. So I definitely do not recommend getting this one just yet. Now, here's one that I want all of us to kind of talk about and look at a lot more specifically. So write this down. We're going to be thinking about student credit cards. So there's a lot of credit cards that are specifically for college and university students with lower credit limits and interest rates than a normal credit card, but that's just to build credit in the short term while you're in college. Specifically, you're not going to be buying a lot of big things. You're not going to be buying a house or a car or just any massive purchases. So this credit card, you don't need that high of a limit, but as long as you're making the reoccurring payments, you're building credit, which is really good. Especially as a college student, it might get easy to miss a payment or just forget. So make sure you're tracking it. But all in all, I think this is a very safe option. I think everyone should be looking out for this. So, some companies like Discover Financial give out student credit cards. So especially when you get into college, get one of these and just use it for all your purchases and make sure to pay it back. Now, finally, there are business credit cards where you use that credit card for business expenses like travel, supplies, equipment. This happens more when you're in the workplace or just like a corporate environment. And obviously, these ones have very high credit limits, but obviously the company is also kind of subsidizing it. So now let's talk about something very important. Basically, what is the structure of credit cards? What are they based off of? What different information am I looking out for? And so this is called Schumacher's box. So if we start out with these different words on the left side, that's exactly what, differentiates credit cards from each other. And that's how you kind of choose which one to pick. So let's start with APR, which also means annual percentage rate. And basically that's the yearly interest you're going to pay on that card if you don't pay your bill in full each month. So every month, if I take out $100 and I pay in full, I'm not going to have any APR. But there's going to be some issues on if I don't pay it back, then I have to pay a fee for borrowing money. And that's expressed mainly as a percentage. So, sometimes you have like anywhere from like 25% down to like 5%. And so basically the whole goal is if you're taking out a loan, try to get an APR less than 10%. And if it's under 5%, that's a pretty good deal. And again, like it says, there's other types of APRs. So for one sort of transaction, you might have a lower APR, and then for something else, you might have a higher APR. It just kind of depends on risk. So be very careful of what that percentage number is. Number two, we're going to have variable rate information. And so, which I talked about, they might have variable APRs, which means the interest rate changes over time. So based on, the economy or the Federal Reserve, if we're at 5% one month, maybe 2 months down the line, it switches down to 4%, then 6%. So just be very careful that you're checking over and over to make sure that you're paying the same APR. Next is the grace period. And this is a number that you guys should mark down on your calendars because that's the amount of time you have to pay in full before you're charged the interest. So if I have a grace period of 30 days, after that billing cycle, I have 1 month to pay back all that money before that interest kicks in. And this is where credit cards really start making their money. Credit companies think that a lot of people are going to miss those payments and that interest is going to be very high, which is easy money for them. So make sure that you're paying it back before the day circled on your calendar. Then some credit cards have an annual fee, which is just how much you have to pay to bank with them. I mean, if you're already making, money off them through benefits and rewards, it's definitely worth it. So that's just the yearly fee. Then you have a minimum finance charge. So this is the smallest amount you can be charged if you don't pay your bill in full. Make sure you know what that amount is because even if you miss your payment just by a few dollars, you're going to be charged this much money. So be very conscious of that. Then some credit cards have transaction fees. So this is when you're making a specific transaction, and based on the credit card company, because it differs wildly, you might have to pay, 2 to 3%. So sometimes if I'm using a specific credit card and I have to Venmo someone, there might be a 3% fee on that just because, there's a fee. There's a lot of cost for, changing money between hands. So in that sense, like just look out for those transaction fees because even though they're small, they're going to add up. And then finally, the penalty fees. So if you miss a payment or go over your credit limit, you're going to be charged a penalty, and that could be a very high amount. So make sure to stay within your bounds just to avoid this unnecessary cost. Now let's look at types of payments between cash, credit, and debt. So I guess all you guys are familiar with cash. It's just the money that you see on the bills, and I mean, all you guys use it. It's good. It's very tangible. You're not paying extra costs on it, but it's not really helping you build your credit like a credit card would. And then we'll actually talk about what debits do as well. So specifically, the whole point of a debit card is you load money on the card beforehand and then you use it. So again, you're using the same money like you are for cash. You're not really getting anything back. But what actually helps you is you don't have to carry all that cash around one place. You just have to carry one card and all your money is stored securely in an account. So if we're going to look at the difference between these three methods, let's start with the credit card, which we just talked about. So for a credit card, you can buy whatever you want, even if you don't have the funds right now, because the company thinks they trust you to pay it back in the next month. There's a lot of consumer protections against fraud because that's what the company is giving you. And it helps you build your credit score, which is huge. But on the same time, we need to think about the cons. Like just because you have that big credit line, that can easily lead to overspending if you're not disciplined. And if that happens, there's high interest rates that you have to pay. And if you have penalty fees or you mess up, that's going to really damage your credit score. So you can go up or down. For a debit card, I do recommend all you guys get a debit card just for certain purchases. It avoids overspending. It's convenient because it's just one single card in your wallet and there's no interest charges. The only issues is, there's a little bit less protection. It's a little bit more vulnerable to fraud, which isn't a huge deal. But if someone gets your debit card, they can just spend it without being authorized. But I would definitely recommend you guys get one of these. And then finally, you have cash, which is great because everyone wants cash and it actually helps with budgeting because you see the money going, but it's just very inconvenient. If you're trying to make $1,000 purchase, it's not safe to carry $1,000 in cash. Now, loans and credit. So we talked about the credit sort of things, but I think loans can be thought of very similarly, where someone's giving you money and a certain time frame to pay it back, and you have to pay an interest on top of that. So let's just think about loans in sense of credit or borrowing money. All right, so there's different places where you can get a loan. And I think loans are a lot higher amounts of money than credit when you need to buy bigger things like a car or a house or even a student loan to go to school if you're going to pay a lot of money. But there are different places where you can get this loan. And so number one, let's talk about the easiest place, which is a bank. And as you guys know, you walk in the bank, they check your score, and based on how trustworthy you are, they're going to give you the money and a percentage that you have to pay. But the rules are very strict on the times you have to pay it back, how much money you have to pay, just the interest. Like there's no really negotiating on that part. And even though the interest rate wouldn't be super high, you need to make sure you follow all their rules to avoid big trouble. But a bank is the easiest place for people to go. Second, you have merchants, which are like stores, or just schools or just people themselves. And the rules are a lot more simple, but they're going to charge a lot higher interest rate, just because, they don't have the capital like a bank does to just be giving out money like that. So their whole point is they're going to lend to try to make money back on the interest. I would still recommend going to a bank because it's safer. Now, peer-to-peer involves people, and you can do it through online platforms that connect, people like this. I would just say like you should be very, very cautious of who you trust by doing this. It is an option, but it's just there's no credibility or security like a bank has. Even though the interest rate can vary highly and you might find a low interest rate, you need to be careful who you're trusting. Then you have payday loans, which are very short but very expensive loans, which give you cash until your next payday. And so let's just say you need $500 now and you're going to be paid $1,000 in a month. You get the 500 now, and then you have to pay it back with a very high interest by next month. So avoid these at all costs. And then finally, you have title loans, which are backed by, the title of items you specifically own, like a car. And so think of it as a pawn shop. Like you're going to get the money for now, you're going to have to give them the title. And if you don't pay it back, they're going to take that item, which obviously means that's very risky. So out of all these options, I highly recommend you just stick with the bank. It's a lot easier and it's just going to be a lot more safer for you. And the reason I'm saying about why it's safer is this big thing called predatory lending. So when you desperately need money, you're going to look for places to take out a loan. And so sometimes, in a bank sense, their goal isn't to, screw you over. It's literally to look at your credit report, see how trustworthy you are, and then base it off of that. Other people might think, hey, this person really needs this money. I'm going to give it to them, but charge a super high interest rate just because I know that they're desperate right now. And predatory lending, where the lender takes advantage of you, is very, very risky because it puts you in huge, huge debt. So, like I was talking about in the last slide, payday lenders often charge the highest interest rate with an APR of 400%, which is absolutely wild. And that's why I did not recommend that anyone take a payday loan. Car lenders also charge super high rates, and so are subprime mortgages. And the huge issue, like I was talking about, is we can look in the past to understand why predatory lending is such a big deal. So if some of you guys aren't familiar, in 2008, America went through a recession where just a bunch of people were laid off. A lot of businesses shrank down in size, and then, just people didn't have the money to spend. And the big reason that happened is of this thing called subprime mortgage rates, which we don't have to get too much into, but that just meant like people were getting charged at higher rates when they were less trustworthy. So they were still getting the loan they needed, but why are we charging people more money to pay back when they have no track record that they can pay it back? So example, if you have a great credit score, we're going to give you $400, and let's just say you guys have to pay us $20 in interest when you pay it back, which is a total of 420 bucks. Not bad. Let's say you don't have a good track record of paying it back. Let's say you have a very fair or poor credit score. Well, we're going to give you the 400 bucks, but you have to pay us back 50 bucks. So now you're giving a person that doesn't have a good track record the responsibility of paying back $450 later on, which is a lot more risky. And that's the reason when a lot of people couldn't pay it back and it all started failing and falling down, the whole economy crumbled. So that's just kind of like a fun fact, but I'm telling you to be very cautious of predatory lending. Now, let's look for the markers which show someone might be doing predatory lending. So avoid extremely high interest rates immediately because their whole point is they don't want you to pay back on the loan, so you're stuck in a debt trap. Number two, look for hidden fees and charges, which is going to be a lot harder, but you need to read contracts in which you're signing. Number three, think about why they're approaching you. So they target vulnerable populations. So if people have bad credit and people are coming to you and offering, hey, I'll give you a lot of money, think about it from their perspective. Why would they do that unless they're trying to be a predatory lender? So be very, very cautious about that. Also look for aggressive marketing tactics. So if someone, a predatory lender doesn't have a good reputation, they're just going to try to market to get more people to actually, come to them. So be very cautious on very high pressure sales pitch. So if someone is pressuring you to do something, never do it. Then avoid when someone tries to encourage you to just keep borrowing. If they just say, hey, you want another 500 bucks, another 1,000, you might need it. Don't. Only take out loans on things you definitely need and you definitely can pay back. And finally, if they don't care about your ability to repay, be very, very cautious. They're not asking you the right information on, hey, what's your plan to repay, or can I see like your income? Then you definitely know they're not having your best interest in for you. Now let's talk a little about debt, because if you do a lot of these steps and you get stuck in a trap of predatory lending or not paying your credit card back in time, you might go into debt, which is the money you owe other people. So before we talk, debt has a lot of connotations. I mean, many people think just the word debt means it's bad. You owe money to someone, you're in trouble. But really, there's a lot of good debt as well. So if I take out a loan for $20,000 and then use it for school, that's good debt, because going to school and getting a degree may help me get a way better job in the future that is a lot more valuable than just 20,000. And I'll easily pay off that loan and it'll set me up for life. But bad debt is the one where you weaken your financial stability. So if I'm taking out money just to buy a new outfit, that's not really helping me in the future. I'm just losing money and now I'm getting stuck in a cycle where I have to pay it back. So there's two options really of paying back the debt. You can start with the snowball method where you pay off the smallest debt first while making minimum payments on the other debts. And this is really easy. So if I have debts everywhere from $50,000 to $50,000, I'm just going to make minimum payments on all of them and then try to pay off the 50 as fast as I can. Then we move on. After the 50 is paid off, go for the 100 and work your way all the way up. That's one method. That's easier if you don't have really the capital to pay off these big debts. The other one is called a high rate method, where you focus specifically on paying the highest debt first, the highest interest debt, to avoid paying more interest. So let's just say one of my interest payments is at 10% and the other is at 5%. We're going to work on removing that 10% one, because otherwise it's just going to keep on increasing and adding up the longer I wait to pay it off. So those are two interests you need to think about. And to actually decide which one you need to do, you need to take all your debts and calculate both of them. And how that works is you need to sit down, or you can go to a financial advisor or find a website online and see which method works best for you and which will save you more money. But again, the whole goal of this class is to help you guys from not going into bad debt, to prevent you guys from taking on bad debt. So hopefully you never have to get this opportunity, but just make sure you know what to do if you ever find yourself in it. And finally, we reach bankruptcy. There's a lot of reasons why people go into bankruptcy. It could be everything from medical expenses to job loss, a divorce, to a failed business. It's just no one really plans for bankruptcy. There's just a lot of factors and a lot of unforeseen circumstances that cause it. And let's just understand what to do if you fall into bankruptcy. So I don't know if you guys have heard of chapter bankruptcies, but they're different. So a Chapter 7 bankruptcy involves you selling your belongings to pay off the debt. So let's just say the bank knows you can't pay off your debt fully. They're just going to ask you to sell as much as you can so they can recoup some of that money. Chapter 13 bankruptcy is reorganization, where let's just say you need to pay off your debt in the next year. They're going to stretch it out over 5 years and create a plan for you to make every single payment. And you cannot miss a single payment. So the problem with bankruptcy is it's definitely going to affect your credit score, like we talked about. It's going to make it harder for people to trust you, and it might stay on your credit report for 10 years. But as long as you're paying it off and being solid with it, it's going to pay off in the long run. So hopefully throughout the entire presentation, we learned a lot of different things about which credit cards to use, how to avoid debt in the first place, and just, how to be careful with our loans. So hopefully a fun fact from now, you're smarter than you were 30 minutes ago. And now we can move on to any questions you guys